All right, we're all set. We'll get it rocking and rolling this morning. Good morning. Happy Tuesday. We got Kane Smeltz here with Kane Mortgage, and he's going to talk to us about some of the programs and what he can do. So I'll hand it over to you, Kane, and we'll go from there.
Okay, let me just open up my sharing screen. So give me a second.
And folks, while he's doing that, this is an interesting thing that's come about for selling investment properties. So anybody that's interested in buying an investment property or selling an investment property should watch this when Brooks sends it out in replay, just so you can get up to speed with what this new program is. So again, take it away, Kane.
Just give me 1 second. Just lost my one screen. I can't see my one screen, so hopefully, can you guys see the screen?
Yep.
Okay. So first off, thanks, Tim, for allowing me to talk today. And hopefully I can provide some good education to everybody. Just a little background on who I am. As far as education, I have an accounting degree. I also have an MBA degree. As far as work history, for 10 years, I worked for large and regional banks as an underwriter, underwriting supervisor, ops manager, got involved in credit policy. I then started my own company. I've had my own mortgage company for over 20 years. I'm also an investor. I currently own rental properties in multiple states. I've owned both commercial and I still own residential. I also did 2 years as a tax preparer, so I'm very familiar or more familiar than most people as far as looking at tax returns. And I believe that owning real estate and owning rental properties is a very beneficial thing. And if used properly, it can provide increased benefits. So I want to talk, excuse me, about financing rental properties. And most of you are going to think about, hey, how can I use or how can my clients use a loan for someone to buy a rental property? And you should, but you should also consider them, your clients, as far as maybe they should be refinancing, because that could put them in a better position. So if they bought a rental property in Steelton for $40,000 8 years ago, that property is now probably worth 140. So they got 100,000 there. Or if they bought a property in Camp Hill for 150 8 years ago, that property might be 300,000. So they got a bunch of equity there. So what is that equity doing for them right now? Nothing. But if they were to do a cash out refi of that property, now they have that money and they can use that for a down payment and settlement cost on a new, bigger primary residence, or they can use that to go purchase another rental property. So there is a lot of the equity that's not being used that they can put to good use if they have the knowledge as far as what to do. Or if you have a client and they have a rental property and they're facing a balloon or they have a hard money loan, potentially refinancing that to a lower interest rate is going to free up some capital for them from a monthly budget standpoint. And now maybe they'll be able to qualify. So yeah, you want to think about advising your clients to use the loan programs I'm going to talk about to buy a property, but don't forget about maybe having them getting a loan to use the equity in the rental properties. So there's basically 3 different ways that you can finance a rental or investment property. The most common is a residential loan. So that's your Fannie Mae and Freddie Mac loan. The second option is a commercial mortgage. So that's your banks and your credit unions. They can do those types of loans. Kane Mortgage can also do those loans in addition to the residential loans. And the third way are the non-QM mortgages, which offer both bank statement programs and DSCR loans to finance a rental property. I'm not going to focus so much on the bank statement programs. They are sometimes a good option for people who are self-employed. The DSCR loans can be used for both people who are self-employed and also your regular W-2 person. So DSCR stands for debt service coverage ratio. My slides aren't going quite in order, but that's okay. So there's three different ways or three different targets or options for you. Again, residential, commercial, and the DSCR program. So when you look at the top line, you have your LTV. So it is possible to purchase a rental property with a residential loan with only 15% down. Well, however, you're going to have PMI. The commercial loan, you can potentially purchase a rental property with as little as 20% down. The DSCR program also allows you to only put down 15%. And the one nice advantage there is no PMI required. The next line is amortization. So this is a very big thing for people. The residential loan allows you to amortize or have a long loan term as 30 years because people want that low payment for the positive cash flow. If you look at the commercial loan, the problem with commercial loans is you're only amortizing it over 20 years. That gives you a larger payment, and sometimes the property may not cash flow. And now we move to the third column, and we're looking at the DSCR option. And that's a great option from this standpoint is because it also gives you the 30-year amortization. When you look at the third row, we're talking about fixed period. How long is that interest rate fixed? Well, I believe most of you know that a Fannie Mae or Freddie Mac loan primarily is a 30-year fixed rate. So the interest rate that you get is going to be fixed for the entire 30 years. When you go to commercial, there are some exceptions, but essentially the interest rate is only fixed for 5 years. Now, your more seasoned investors aren't going to be overly concerned about that. But your newbies, your clients who are first-time investors, that's going to make them fearful. They are afraid that, hey, what happens after 5 years when my interest rate adjusts? Again, the third column is the DSCR. The interest rate is fixed for 30 years. So you're taking the fear out of your clients because don't worry, your interest rate is locked in for 30 years. If rates go up, you're A-okay. Your loan term is not going to change. The fourth row is PPP. So hopefully you all know what PPP is. It's prepayment penalty. On a residential loan, right now, you don't have any prepayment penalties. We'd have to go back to 2008 where we saw any type of prepayment penalties on any standard secondary loan. So right now, we don't have any prepayment penalties on any standard residential loans. As far as commercial, you typically have a prepayment penalty, which coincides with the fixed rate period. So if your fixed rate period is for 5 years, you have a prepayment penalty for 5 years. The DSCR loan will generally not have a prepayment penalty. Now that depends on the state of the property. So for instance, my company, Kane Mortgage, can do the DSCR loans in 46 of the 50 states. So if you have a friend or family member that wants to buy an investment property in Maine or in Georgia or in Texas, that's fine. Have them give me a call and we can assist with that. So it goes state by state. I'm just going to focus on Pennsylvania. So the majority of the time, you will not have a prepayment penalty on the DSCR loan in Pennsylvania. The exceptions could be if it's a 3 or 4 unit property, or if the loan amount, I forget the exact amount, but I think it has to exceed like $320,000. So for the loan amount to exceed $320,000, you're talking about a property that's worth $400,000 or more. So just because it is a 3 or 4 unit property, or if you have a loan amount $350,000 or more, you have the option to waive the prepayment penalty or to take the prepayment penalty. If you take the prepayment penalty, it actually gives you a lower interest rate. but the majority of the time, your clients are going to have a loan amount under 300,000, and it's going to be a 1 or 2 unit property, so they're not going to have a prepayment penalty. The 1, 2, 3. The fifth row is ownership. This is a big thing. For a residential loan, the property can only be owned in the person's name. So Joe Smith, Mary Schreffler, only in their personal name. The advantage that a commercial loan has over residential in this case is the ownership can be in the person's name, or it can be in the name of the entity. So if they have an LLC set up, the LLC can own the property. They still have to sign a personal guarantor as a personal guarantor, but they can own the property in the name of the LLC. When we get over to the DSCR option, that gives us the same flexibility as a commercial loan. You can own the property in your personal name, or you can own the property in the name of an LLC. So I believe most of you would agree and probably would advise your clients, hey, when you're buying a rental property, put in the name of an LLC. Well, if you put in the name of the LLC, that's going to disqualify the residential loan options. When we get down to the next row, we're going to talk about qualifying. And I actually have another slide on this. But essentially, in the best case, your DTI, your debt to income ratio, cannot exceed 50% for a residential loan. If it does, if it's over 50, you don't qualify. When you look at qualifying for a commercial loan, there's essentially 2 things that are looked at. You look at the global debt ratio, or DTI, and basically that should not be exceeding 43%. And you're going to look at your debt service coverage ratio, and that needs to be at least 1.25. So you're supposed to qualify and meet both of those requirements. If you don't meet the one, it is still possible to be approved if you're very strong in the other, and if you have other strong attributes like a like a high credit score, maybe like a lower loan to value. The DSCR provides a lot of flexibility when it comes to qualifying. So if your DSCR is 1.5, that's fantastic. You're going to get a lower rate. If it's 1.25, your rate might be a little bit higher, but you're qualifying. If it's a 1.0, you still qualified, the rate's a little bit higher. If your debt service coverage ratio is below 1, you can potentially still qualify with a DSCR loan to buy an investment property. However, the rate's going to be a little bit higher, and maybe your loan to value gets cut, but you can still qualify. Even if your debt service coverage ratio is 0.2, you can still qualify. Now, you can say, why in the world would anyone want to buy a rental property if the rent is not covering the expense, if it has a negative cash flow? Well, there's different reasons. And I'll just give you one example. I had a client, and the lease that he had in place was about 75% of the current market rate. And he went to refinance that property and pull some cash out, and he was denied at several other places. And the reason why his rent was so low was because his tenant was also his employee. So he was giving a break to his employee on the rent. He was renting to him. He was renting the house to his employee under value. So there was a reason. He was trying to help out his friend, his employee, his buddy. But thankfully, the DSCR loan option that I had for him allowed him to qualify, even though the debt service coverage ratio was less than 1.0. Now, I'm going to get to another slide that's going to give you more detail on exactly how that debt service coverage ratio is calculated. When we get to the next row, it's docs or documentation. So how are you going to qualify for these three loans? For a residential loan, you basically need, depending on your qualifications, anywhere from 1 to 2 years worth of income documentation. So if a person is a W-2 person, in some instances, we can get away with one W-2 and the most recent pay stub. Depending how they're paid, maybe we need 2 years of W-2s, maybe we need 2 years of tax returns. So it just depends on the scenario. When you get to commercial, the borrower will need to provide 3 years of tax returns in order to qualify. When you get to the DSCR loan, it's nothing. On the application, their employment is not listed. They do not provide pay stubs. They do not provide W-2s. They do not provide tax returns. They don't have to provide any income or employment documentation on the DSCR loan because the qualifying is based solely on the cash flow or the debt service coverage ratio of the property. And we're going to talk more about that on a following slide. The next row is credit score. So in theory, you can be approved for a residential loan to buy an investment property with the 620 credit score. Now, it's probably unlikely, but in theory, it can happen. So if you really do have that 620 credit score, I can tell you, you're not going to qualify to 85% loan to value. It's probably going to be 75 at best case. But in theory, you can qualify with this 620. Commercial, it's not a hard and fast, but probably a rule of thumb, you're going to need to have a credit score somewhere around 680. From the DSCR loan, the higher your credit score, the lower your interest rate. But if you have a 620, you can qualify for a DSCR loan. It's not like, well, maybe or maybe not on the residential, which is a maybe or maybe not. On the DSCR, you can qualify with a 620. Your loan to value is just going to be reduced. So your loan to value is probably going to be 70% at a 620 credit score.
Kane, can I ask you a question here on that
Sure.
one? When you're talking about that 620 credit score, what happens if it's an LLC? Do they still go out, look at your personal credit score?
Yes, because you're signing as a personal guarantor.
Okay,
right.
All right. Just
So
want to make sure.
still going to be the LLC is the borrower, but Joe Smith, who owns 100% of the LLC, we're going to pull Joe Smith's credit report to see what his credit score is.
Okay, thank you.
Yeah. Because you said that, so let's suppose you have a company, Big Properties LLC, and you have two owners, both are 50-50. In some cases, I'm going to need the loan in the name of both people. So if you have two 50-50 owners, I'm going to have two 50-50 guarantors. In some instances, I only need one of the people to be on the loan and to be a guarantor. It depends on who I'm selling the loan to. So I have approximately 15 different investors that I sell the DSCR loans to. The reason that I have 15 different investors that I sell these DSCR loans to is because the concept is the same as far as how the debt service coverage ratio is calculated, but they all have tiny differences in their guidelines. So for instance, some will not lend in rural areas, but some will. most of them have a minimum loan amount. So some don't go below 200, some it's 150, some the minimum loan amount's 100,000. I have two investors that don't have a minimum. So even if you have somebody that's buying an $80,000 property, which is really hard to find these days, I still have two DSCR investors that I can sell to. Not all of them go to 620, but some do. Not all of them allow a debt service coverage ratio under 1.0, but some do. Some of them require 6-month reserves. Some of them only require 3-month reserves. So the guidelines vary dramatically between the big Wall Street firms and the insurance companies who are basically buying these loans, who I'm selling to, my investors. So that's why I have so many, because the guidelines are very varied. And, your clients and my borrowers all have that slightly little different tweak. And that's why having so many different options is beneficial. Hey, I actually got I figured out what I was doing wrong. So give me 1 second to, this is how my presentation is supposed to be working. I forgot to push the one button. So when we talk about qualifying, the residential loan, remember, it's your DTI. Your debt to income ratio should not exceed 50%. When we talked about qualifying for commercial or the DSCR, the commercial, they're going to look at your global debt ratio, but also the debt service coverage of the property. And the DSCR is just the debt service coverage. So the DSCR is easy. It is 100% of your rent divided by the PITI. And for those of you that don't know, the PITI is your principal, interest, tax, and insurance, HOA if applicable, PMI if applicable. So simply your rent divided by your mortgage payment. Straightforward and easy. So the higher that percentage, the lower your interest rate. And again, I can get away and get approved with one under 1.0. The commercial, a little bit different. It's your rent, but it's only 95% of your rent because we have to account for a 5% vacancy rate. And then we're going to divide that by the PITI. But here's the catch. Remember, the commercial loan term or amortization is only 20 years. So you already start with a higher mortgage payment. Then in addition, we have to add a 5% management fee and a 5% maintenance fee. And we have to account for all of the utilities that the landlord pays. So that's going to give you a lower debt service coverage ratio in the commercial loan because we're hitting the income and we're adding more expenses, and you still need to have a 1.25. So that's how you can see the debt service coverage, the DSCR loan, is going to be easier to qualify. So if you ask, well, who is the best fit for the DSCR loan? I think I gave you a bunch of examples, but anyone and everyone. So if a person wants to own the property in their LLC and have a 30-year fixed rate, there's only one option. If you have a person and they show a loss on their tax returns, there's probably only one option. If you have a person that just became self-employed 6 months ago, even if they're in the same industry, they're not going to qualify for a residential loan. They're not going to qualify for a commercial loan, but they could qualify for a DSCR loan because I'm not looking at their tax returns. Sometimes I've had people where they didn't qualify for the other loans because their their debt to income ratio was too high because they co-signed for their kids' student loans. They co-signed for their niece's car loan. But that's not a problem on the DSCR loan because I'm not looking at their DTI. Sometimes you simply have people they don't want to provide the tax returns, the information. They think it's too complicated, or maybe they have something they want to hide. That's okay. I don't need it. I don't want to see it. The DSCR loan does not require it.
Is the interest rate based on the credit score?
What's that?
Is the interest rate based on the credit score?
It's based upon a couple things. It's based upon the credit score. It's based upon the loan to value. And it's based upon the DSCR percentage. So if you have a person with a 800 credit score, and let's suppose that you're only going to 80% LTV, and let's suppose that you have a debt service coverage ratio simply of 1.0. So nothing crazy, right? You don't even have a 1.5, just a 1.0, 80% loan to value with an 800 credit score. You can get, and this is with no prepayment penalty. You're looking at 7.75%, 0 points. Now, let's suppose that's a 3-unit and you can put a prepayment penalty on. You can actually get 7.25 and 0 points.
And is the prepayment penalty, is it 5, 4, 3, 2, 1, or is it?
Correct. Yeah. Yeah. Well, I actually have options. So
Okay.
I can do the 5, 4, 3, 2, 1. I can do a 3-year prepayment penalty. So it's a 3, 2, 1. I have a 2-year prepayment penalty. That's 2 and 1. But again, the prepayment penalty in Pennsylvania can only be added if it's 3 or 4 units, or if the loan amount, I don't know exactly, but I think it's like 320,000. So many times it's not even an option. So many times it won't be there.
Okay. So folks, this interest rate that he's talking about, just hypothetically 7.75, what that is typically like what I'm paying to get commercial money.
Yeah.
And I'm only getting commercial money at 20-year amortization, 25-year if it's a newer property. Kane's able to do that at 30-year, and you're locked in at that rate. Now, if the rates go down, obviously, you probably could come back to you and refinance it.
Exactly. And
Right.
Your commercial loan 100% has a prepayment penalty.
Yes.
This rate that I just quoted has no prepayment penalty. So if the
Right.
rate does fall, absolutely you want to refinance in.
Do those prepayment penalties run the entire term of the loan, or do they expire after a certain time frame?
There's options. So you have the 5-year prepayment penalty is 5% the first year, 4% the second, 3% in year 3, 2% in year 4, and 1% in year 5. But that's if it's selected. And remember, it can only be selected on a 3 or 4 unit property. So it's not even possible on a 1 or 2 unit. And it's not possible on a loan amount under 320,000.
Kane, is there a number of, excuse me.
No, go ahead.
Is there a number of these properties that you're allowed to own or finance? Are we restricted as to you can only own 4 in each LLC or your personal name or anything like that?
Essentially, no. Because all of the investors that I sell to, they do have caps. Some are 10 or 20. So if you have a client that comes to me, right, and they want to go on a buying spree, even if I sold, so I'm going to originate in my name. Most of the time, I'm the lender. I'm I'm funding the loan, I have my Wilton warehouse, and then I'm selling off, right? So even if I were to fill the bucket at that investor with 10 loans, guess what? I will sell the next 10 loans to a different investor.
Okay, good.
And I have 15 different investors, so it's practically impossible to fill the entire bucket up.
Okay, good. Thank you.
Yeah.
That's important. Yeah. Because this takes a lot of, for those that own lots of properties,
Mhm.
this gives you that 30-year amortization to cash flow. Because you have to decide, what are you looking for? Are you looking for passive income to live off of? Or are you looking for not cash flow and get it all paid for,
Right.
over the next 15 years of your life, that type of thing, 20 years of your life.
Yeah.
So everybody has a different theory of how they look at investment properties. But the passive income allows you to use that income to buy other things. So this is exciting, to be quite honest. I'm excited about it. It really opens up the doors. Now, when you say in rural areas, um, you're saying you can still do it, but there's just certain investors that'll do it?
Right. It's going to have some limitations. So I don't know if you ever heard of the Starbucks rule. Okay. So the Starbucks rule is if you are not within 20 miles of a Starbucks, you're rural.
Okay.
Okay. So that's not used by everybody, but it's used by a lot of people in the lending industry. So I have some investors that won't lend in rural areas, and I have some that will lend in rural areas. So, for instance, let's just pick on.
Will they consider Dunkin' Donuts?
I think it's the same concept, right?
Okay.
If you're within,
And the reason I'm asking is, like, you've done a lot of business with Regina up in Potter
yeah,
County. They're getting ready to open up a ski resort up there again that has been out of business since 2015. That could make certain sections of that rural area
yeah,
popular and worth more money to appreciate. So if we
sure,
were to go out there and buy some single family residences and they're within 20 miles of a Dunkin' Donut or a McDonald's,
yeah,
would they consider that?
yes. So if I go back to this screen here, give me 1 second. Oh, this one right here. So in the case of the DSCR column, okay, if you have a rural property, that's going to be okay, but maybe there I can't do the credit score of 620. I
Right.
can't tell you exactly what it is, but maybe you need to have a 680. Maybe there I can't get away with a debt service coverage ratio under 1. Maybe you need to have at least a 1.0. You're not going to get 85% LTV, but you'll get 80, worst case 75. So it gets a little bit more restrictive, but it's still possible. So even if it's 75, that's still kind of in line because a lot of the banks and credit unions that do commercial loans, and I can also do commercial loans, are going to restrict you to 75% anyhow, especially if it's in a rural area. So it can still be used, but I'd say, give me the exact scenario. What kind of quality borrower do you have? If it's a 630, it's probably a no-go. If the person has a 780, even a 720, it should be a-okay.
And if you can just tell me quickly, how do
Yeah,
you figure out this 1% debt service ratio again?
yeah.
You can show us that? Okay.
Right down here, I don't know if you can see my mouse moving, the DSCR, the bottom part, the rent. So let's make this realistic. Let's suppose you have a property and the rent is $1,500 a month, right? So if you take 1,500 and you divide that by 1.25, and I'm just using 1.25 because that's your standard commercial, that's $1,200. So your pity cannot exceed $1,200. Now, in many cases with the DSCR, I can go down to 1.0 real easy. And again, I told you, in some cases, I can go below 1.0. Okay. So that means that if your rent is 1,500, as long as your pity does not exceed 1,500, you qualify. Now, again, here's a good example of why I sell this loan to 15 different end investors. Some of the investors will go by the worst case between what the property is currently being leased at and what the appraiser states is the current market rent. However, I have some investors and guidelines that I sell to, and they will use the best case scenario between what the property is currently being leased and what the current market rent is. Now, in that case, let's suppose for the sake of argument, you have a client and they're buying a rental property and they're renting that property for $2,000 a month. And the appraiser comes back and says, hey, the current market rent is only $1,500. I can still use that $2,000, but to ensure that that is a valid number and not just a make-believe number, that they just didn't do the lease last week to qualify, we'll need to have proof that that rent of $2,000 was received for the last 3 months. So if we can get proof that that rent of $2,000 was received for the last 3 months, then we can use that $2,000 instead of what the appraiser is saying is the current market rent of $1,500.
Okay, so then my question would be, if I'm going out and I'm buying a single family ranch home, and the appraiser says, okay, the rent is the applicable rent for this is $1,500 a month, and we have a credit score of 800.
Yeah.
Okay. Does that property have to be rented at the time of closing, or can it be used based on the appraiser's evaluation of the 1,500, or do you got to go find a tenant in advance?
Nope. It can be used based upon the appraiser's market rent, stated market rent of 1,500. Okay. So right, so you're buying the property. Joe and Mary
owners move out.
Yeah. Right, and yep, and you're gonna put a tenant in there. Yes. Here's the other thing. This happens a lot. Excuse me. I have investors and they say, I want to go buy this ranch house and I am going to run it as a group home and rent it to an agency that's going to have some mentally challenged people in it. Okay. That can be difficult if it's set up like that. But if they're buying the property and they're saying, Kane, we need a loan, okay, I don't know who the tenant's going to be. So we're just going to have the appraisal done. The appraiser's going to say, hey, the market rent is $1,500. Boom. That's what we're using for the number, $1,500 for the rent. We close the loan. And then I don't care who he puts in as a tenant, what agency, what other company, 15 people. I don't care if he rents rooms in the house, because we're giving him the loan before he or she does something non-typical with it.
So in my commercial loans, I have an obligation every year to provide rent rolls and tax returns and stuff like that. Is there any obligation other than you're just securing any leases that are on it?
Nope. So come January, you do not need to give me an updated personal financial statement. You do not need to give me any tax returns. You do not need to give me any lease. You do not need to give me anything. I don't want anything. You don't have to provide anything.
Yeah. Let me
Easy.
tell you something, Kane. This is the best program I've ever seen. And if we, as agents, don't take advantage of this right now while it's still there, I mean, we might never have another opportunity like this.
Mhm.
So I think this is awesome. Really good.
Right.
Yeah. Especially for somebody that wants to get into owning investment properties. Or maybe, like you said, cashing out on some of the ones that
Yeah.
you already own and refinance them, pull some money out to buy more and leverage your equity by buying more. So, I mean, the object of real estate agents is to like not show a lot of income so you don't have to pay a lot of taxes. But if you have a great credit score, you can create massive passive income with this program. I love it.
Yeah. Because, hey, if you have a stock, you know, the stock doesn't do anything for you. Really, how much is it worth until you sell the stock, right? The rental property is the same thing. If you have all this equity, what is the equity doing for you? But if you pull it out and you can use it to acquire something else, now you really have the chance to build wealth.
Yep.
Or like I talked about, remember, if suppose you have a person and they have two rental properties, they don't want to own any more, but they want to buy a big new primary residence, and maybe they just don't have the money for that large down payment. Maybe they don't have the money for a large EMD. Tell them, hey, why don't you use the equity in your rental property? Pull it out, put it to good use. You know, that you might be able to. Here's the other thing. Suppose you have a person and they bought, you know, three properties in Steelton 8 years ago, and then they stopped. And so they have all this equity sitting there, right? Well, how all of you are successful with your clients when you're putting an offer in, the best offer is a cash offer, right? So what you can do is they can do a cash out refi of these investment properties. And now they have enough money that they can be a cash buyer of another property. You're more likely to win. And then as soon as they purchase that property with cash, they can then refinance that property and pull their cash back and basically rinse and repeat.
Yep. Kane, do you have any of this that applies to new construction? That if we wanted to build a rental property, new construction like this? Because,
Um,
like, for instance, I own 11 lots down in Lewisberry that I want to build homes on to rent. So I'm kind of stuck with going with a commercial lender,
right.
to do that. But if I did these individually with you, or would I have to build it and then do it? Like do a construction mortgage, build it, and then flip it to you to put a permanent loan on it?
It's a different program, but I actually do have some round up construction loans for investment properties, but that's an entirely different program. But I can talk to you about that
But
later.
I could do it that other way though, right? I could use my line of credit for my construction
Mhm.
company, go
Yeah.
out and build a $400,000 house. The
Yes.
appraiser comes in and says, "Oh yeah, you can lease this for 2,500 a month." And then when it's built, then I could sell it to myself and do this loan through you.
100%.
Yeah.
Without a doubt. Yes.
Okay.
Yeah.
Tom Chilednik, you own a lot of investment properties. Does this sound interesting to what you've been doing over the last 20 years? Because I know you own a whole lot of property. There you go.
I've done a lot of the ones I've lived in. Obviously, I was able to finance them as an owner occupied when I started out. But since then, I do a lot more of the commercial where you got the
Hmm.
5 year balloons or, years ago, a lot of them allowed us to go into like 15-year balloons and just haven't done anything recently because the interest rates are so high and to make the numbers work, it makes it more difficult. but I
Other
do
than the
like,
30-year amortization will help with it. Yeah.
yeah, I've got, S&T has, well, probably about 10 years ago, I used S&T and they had a 30-year AM and I refinanced two of them that way, which, I mean, it's really good. I mean, the rate's like 4.5%. It's a 30-year AM. And it's fixed. So and it was for commercial, for a rental. It was a great
Right.
product. So at this point, you don't want to do anything with that. But I do like the fact that some of these are paid off, and I do like the cash. I always struggle with going in and doing what Dean's talking here, taking the money out, or like you're doing, going to something else, because there's some, you're really leveraging yourself when they're paid off, they're cash flow, and it's a little bit of weight off your
Nice.
shoulders. It's
Yeah, it
nice.
depends on what position you're in to build more
Yeah,
wealth, to
yeah.
live off the
But
cash flow that you've
but I
earned.
I- but I do have an investor who is looking, and I'm going to float this one by him. Uh, there are, and I do like the fact you don't have to do the every year your personal financial, give them all your tax returns and stuff, which gets to be annoying over years.
Right.
But yeah,
Sounds good. Anybody
yeah.
else have any other questions for Kane? Brooks, you got anything? What do you think about the programs?
No, I don't really have any questions at this point. I was curious about the question that you asked about if the property is not currently rented or not, and being able to use an appraiser's applicable market rent in those instances is cool. But it definitely seems like a beneficial program that can give you some flexibility in what you're buying. So.
It sounds almost, Kane, like you're at maybe prime plus a half, is what these rates are somewhere about, or prime plus a quarter. Unless you go with the penalty.
Right. And that was a reasonable example where I gave you, because that was an 80% LTV, right? So if you went with an 85% LTV, then the rate's higher. But if you went with a 75% LTV, then the rate's lower. So it just kind of depends. But yeah, I would agree. That's kind of where they're at roughly right now. A quarter
What
to
about
half.
50% LTVs? How
Oh,
low
that
could you
improves
get?
the rate.
Yeah, what do you think the rate hypothetically would be?
Uh,
And the reason I'm asking is, like, for me, I have one that just ballooned the other day, and I'm switching from S&T to mid-pen to put a rate on it. But now I might look at your program here because of the 30-year amortization. But I've got lots of equity in the property.
I'm trying to pull. If I were just to guess, I'll just give you a guess. I'm trying to pull something up. I can't pull it fast enough. I'll probably say then you're touching the high sixes.
Okay. Yeah. So somewhere 7 or a little bit shy of 7. Yeah.
Yeah.
Okay. Interesting. Anybody else have a question they'd like to ask Kane while we're on the call? Hopefully you explained it. I did snap some of the slides so that we have that information, unless you can send us the slideshow. But I think it's a great program. You did a great job, Kane. I'm actually very excited to use this. I'm pumped up now.
Great,
So
thank you. Yeah, I can
yeah,
send that to Brooks.
especially when you don't have to worry about the debt to income, and you don't have to worry about qualifying,
Mhm.
you know. But sometimes we run across a great deal, and the people look at it and like, I can't buy it because I'm not going to qualify, you know. And that, like, for me, I'm going to be 100% transparent and honest. I don't qualify for these traditional programs. I have to go commercial because of the amount of properties that we own. So this opens up a whole new spectrum of possibilities for me. So I love it. Okay,
one,
yeah.
one other thing, I think I touched on this, unless I got sidetracked. I have, again, the different investors all have different guidelines, right? That's why I'm selling to essentially 15 different investors after the fact, okay? So I know what the guidelines are to make sure that people are going to qualify up front. But let's suppose you have an LLC and the LLC has two members, both are 50% owners. And let's suppose that the one guy's name is John, and John has a 580 credit score. And John's partner is Mary, and Mary has an 800 score. I can be selective in who I'm selling the loan to, and I just won't have John on the loan. I'll only have Mary on the loan. So it's in the name of the LLC, but I'm going to only have Mary on the application. And now I can look at Mary's 800 credit score and ignore John and his low credit score. And by using Mary and her high 800 credit score, I can go to a higher loan to value, lower down payment, and provide a lower interest rate. Now, that may not work in the rural, right? That may not work on some of the other scenarios. But if I have somebody, and that's the case, so they have three owners, 33, 33, and 33, and two of them have really low credit scores, I can just use the third person that has a high credit score. So there's some other restrictions, but this program provides a lot of options, a lot of workarounds. So I'm just throwing that out there as well.
Yep, sounds good. Anybody else have a question for Kane while we have him? Speak now. Kane, again, thank you very much for joining our call this week. I think you did a great job, very informative. Brooks, anything else to close it up?
Nope, all good.
Sounds good. We'll be in touch, and I got your number and your email in case any of our agents want the information. They not only are on this call, but we have a group that always watches it after when we publish it. So thank you very much for joining us today.
All right, super. Thanks. Thanks, everybody. Have a great day.